Hi, I'm John Prasinos, Editorial Director of Investing Daily, with a video update for Monday, September 21. We all need to face the fact that the coronavirus hasn't gone away. Indeed, in some places, such as the Midwest, it's actually getting worse. Even if all business lockdowns ended tomorrow, consumers would remain skittish. Until the virus is under control, the economy will never properly mend and financial markets will remain under pressure. Stocks finished last week at a 6-week low, falling for the third consecutive week. Driving the downward momentum was a further sell-off among big tech shares. Take a look at my first table. Tech shares have been overvalued and their recent declines are actually healthy, but the declines probably aren't over. Also weighing on markets last week was the Federal Reserve's announcement on September 16 that the overnight rate would remain near zero through 2023. Stocks swooned in response as investors interpreted the central bank's extreme dovishness as a sign that the economy is in long-term trouble. Betting on a V-shaped recovery is, frankly, it's magical thinking. Last week, World Bank officials warned that a sustained and robust global economic recovery from the COVID-19 pandemic may take as long as 5 years. In the U.S., consumer spending remains uneven. According to the U.S. Census Bureau last week, seasonally adjusted retail and food services sales amounted to $537.5 billion last month, an increase of 2.5% from the same period last year. However, spending levels are still far below pre-crisis levels for many retailers. As quarantined consumers change their buying habits, we're seeing the emergence in the economy of pandemic winners and losers. Take a look at my second chart. Many stores, restaurants, and bars are shuttered and will never open again. In the decimated retail and hospitality industries, many workers, they live paycheck to paycheck. Their pain right now is acute. America's wealth inequality hovers at levels unseen since the Roaring '20s. What does today and that bygone era have in common? An unsustainable stock market bubble. The Labor Department reported last Thursday that an additional 860,000 workers filed new claims for unemployment for the week ending September 12, down 33,000 from the previous week and versus 850,000 expected. The overall unemployment rate continues to fall. That's true, but it remains extremely high. Take a look at my third chart. Thursday's figure did mark the third straight week that new jobless claims remain below the psychologically important 1 million level. But, as I've warned you, the Labor Department recently implemented changes in the way it calculates unemployment numbers, so unemployment is probably worse than the numbers say. A major tailwind for stocks has been expectations of a coronavirus vaccine being developed and distributed before the November election. The vast consensus of experts is that the emergence of a vaccine before the end of the year is nearly impossible. So you need to tune out all of the white noise about vaccines. That white noise is leading a lot of investors astray. Well, that does it for now. In the meantime, if you purchase new risk-on assets, I recommend stop-loss orders, elevate your cash levels, and please stay safe. You can reach me at mailbag@investingdaily.com. I welcome your comments and feedback. Thanks for watching.